Welcome in this video. Now we are learning TY become semester 5th internal reconstruction chapter, and already I think 1 to 2 problems we discussed. Now we are moving next problem, which is illustration number 6. First of all, let's see what is the problem. The following is the summarized balance sheet of Safe Moving Limited as on 31st March 2018, and we have to prepare they given as past journal entries and prepare a capital reduction account in the books of company. So any problem, you must find out this line, what you have to prepare. So first, prepare journal entries, Safe Moving Limited journal entries with numbers, particular, debit rupees and credit rupees column. Next, you have to prepare capital reduction account with debit and credit side. Okay, utilization and sacrifice. Let's start. There is a note. There is a contingent liability for damages rupees 60,000. There is a contingent liability for damages rupees 60,000, and preference shares are cumulative and dividends are arrears for 3 years. But we will solve this adjustment after 1 to 3 adjustment, A, B, C, D. Then we will move for contingent liability and preference shares. Let's check first adjustment. A capital reduction scheme setting up the following terms and duly approved. The preference shares to be reduced reduced to 8 per share. Preference shares to be reduced to 8 per share. So value of our preference share is 10. You can see here 60,000 6% preference shares rupees 10 each. That is 6 lakh. So the preference shares to be reduced to 8 per share means we have 60,000 preference shares and it's reduced to means the value of preference share is 8. So 60,000 into 8 equals 4,80,000. So value of our new preference shares will be 4,80,000. So our entry will be, so write it down, preference share capital account debit, which is 6 lakh total value of our preference shares, to preference share capital rupees 8, to preference share capital account rupees 8, 4,80,000, and the remaining balance will goes to capital reduction account 1,20,000. Reduction for narration for this transaction is being reduction of 60,000 preference shares of rupees 10 each to equal number of shares of rupees 8 each. Next part of the adjustment, and equity shares to 25 paisa each. 25 paisa means 0.25 0.25 rupees. 25 paisa means 0.25 rupees. So we have 12 lakhs equity shares of rupees 1 each. So 12 lakhs into 0.25 rupees equals 12 lakhs into 0.25 equals 3 lakhs. How much? 3 lakhs. So we have equity shares amount is 3 lakhs. So give a debit to equity share capital 12 lakhs or main value. So reduction in capital share, equity share capital account rupees 1, 12 lakhs to equity share capital account 0.25 new equity shares, and the balance will goes to capital reduction account which is 9 lakhs. Our narration will be reduction of 12 lakhs equity shares, equity share capital of rupees 1 each equals to equals number of shares of 0.25 each wide scheme of reconstruction dated. So next part to be considered as a shares of rupees 10 each. Okay, 1 minute. Each and to be considered as a shares of rupees 10 each and 1 each fully paid respectively. Okay. The preference shareholders waive 2/3 of the dividends in arrears and receive equity shares for the balance. The preference shareholders waive 2/3 of the dividend in arrears and receive equity shares for the balance. So here is the adjustment. The arrears of preference shares, cumulative and dividends are arrears for 3 years. So our preference shares are 60,000 preference shares and the amount is 6 lakhs. So 6 lakhs into 6%. 6 lakh into 6% equals 36,000. And the arrears of preference shares dividend is for 3 years. So 36,000 into 3 we get 1,08,000. So our total dividend arrear is 1,08,000. In this dividend we waive 2/3 of dividend and remain 2/3 of dividend in arrears and receive equity shares of the balance. So balance dividend will be 1,08,000 into 1 divided by 3. The 2/3 are we forgo or waives. So the remaining balance is 1/3. So 1,08,000 into 1/3 into 1 divided by 3 equals 1,08,000 into 1 divided by 3. So we have 36,000 amount. And the balance is receive equity shares of the balance for the balance. So capital arrears of preference shares for dividend, capital reduction account debit which is 36,000 to equity share capital account 36,000. Discharge of 1/3 arrears of preference shares dividend 1,08,000 by issue of equity shares. So equity shares capital is our liability, so you have to give credit to it and debit for capital reduction account. Next adjustment. The authorized capital to be restored 60,000 preference shares of rupees 10 each and 12 lakhs and 12 lakhs. Next, the share in subsidiary limited are sold to the outsider for rupees 3 lakhs. The shares of subsidiary limited are sold to outsider for rupees 3 lakhs. So we sold our investment in subsidiary limited, which is 1,50,000, and now we are sold this investment for 3 lakhs. So we get 3 lakh balance, cash. Debit what comes in. So we have to give debit to bank, which is 3 lakhs, and our investment amount is 1,50,000. So investment is goes out. So 1,50,000 will be credited, and the remaining balance goes to capital reduction account. Our narration will be being investment sold, profit on sale transfer to capital reduction account. Next adjustment. All intangible and fictitious assets are to be eliminated, and bad debts 40,000 and obsolete stock rupees 6,000 to be write off. In this adjustment, all the assets are going to write off and eliminated. So our intangible asset is goodwill. Then we have fictitious asset, profit and loss account, and advertisement expenses. And our stock is write off for rupees 60,000, and there is a bad debts for 42,000. So if assets are going down, so we will give credit to assets. So profit and loss amount is 5,28,000. Then advertisement expenses 1,20,000. Then goodwill is 2,40,000. Then stock 60 and debtors 42,000. And here is the sum of all these credited values, 9,90,000. So we will give a title as capital debit to capital reduction account, and our narration will be being value of asset and profit and loss account adjusted against capital reduction account wide scheme of reconstruction dated. Next adjustment. The debenture holder to take over one of the company's properties, which is book value is 1,08,000, at a price rupees 1,20,000. Prepare a working note for this adjustment. Land and building, because they are taking our asset taken over by debenture 1,08,000, which is revaluated as 1,20,000. So we get a profit rupees 12,000. The balance of land and building will be 4,26,000, because the total land and building is 5,34,000. Why we choose land and building? Because they are taking our company's asset. In the part satisfaction of the debenture holder to provide further cash 90,000 on a floating charges. Okay, it will the next adjustment. So our debenture holders amount is 1,20,000, and 1,08,000. So settlement of debenture is as follows. The amount of debenture is 1,20,000 debenture. So debenture is our liability. Now we are setting it for settlement of debenture. We will give a debit to it 6% debenture account to land and building, because they take over the land and building, and the balance will goes to the capital reduction account 12,000. So our narration will be, being debenture partly settled by way of property appreciation in value credited to capital reduction account. Next adjustment. In part satisfaction of debenture and to provide further cash 90,000 on floating charges, the arrears of interest are paid. Part satisfaction of debenture provide further cash. We are providing cash for debenture order. They are providing cash for it. So we get 90,000 cash. So bank account debit to 6% debenture, and our narration will be further issue of debenture against floating charges. Now we are issuing debentures for rupees 90,000. Next, the arrears of interest are paid. So interest on debenture is 12,000. Debit what comes in, credit what goes out. Cash is, we are paying debenture interest. So debenture interest will be debited and to bank will be credited. Payment of accrued interest. Next, director refund 20,000 of fees previously received by them. Directors are refunded 20,000 fees. So we get 20,000. So bank account debited to capital reduction account. Fees refunded by directors. Next, the contingent liability materialize in the sum stated, but the company recovered 30,000 of these damages in action against one the director which was debited to his loan account for rupees 48,000, and the balance of loan was paid in cash on his resignation. So the amount of director loan is 1,50,000. Prepare a working note for it. Director loan is 1,50,000 and we paid 48,000 for it. So the other liability will be 1,02,000, the remaining balance. In this loan for 48,000, record damage is 30,000 and we paid a balance paid in cash, rupees 18,000. So our amount will be director loans, which is 48,000. We paid 18,000 as a cash. The remaining amount will goes to capital reduction account. Damages recovered 18,000 from director adjusted in loan account credited to capital reduction. Capital balance loan paid in cash. And we issue equity shares for the remaining director loans, which is 1,02,000. So the capital reduction account is debited. So the director loan account is debited and to equity share capital account 1,02,000. So the narration will be director loans balance settled by issue of equity shares. Next, the remaining directors agree to take over equity shares in satisfaction of their loans. Yes, we already did this adjustment. And we have to pay the contingent liability for 60,000. So we are paying liability, so cash will goes out. So contingent liability for damages, capital reduction will be debited and cash will be credited. So contingent liability paid 60,000. So our entry will be capital reduction account debit to bank account. I think we cover all our adjustments. So let's check it. The journal entries, yes, all are done. Next, consolidation of equity shares. The consolidation of equity share is, now take a calci or calculator and add all the equity shares amount. We have equity share capital as in the first journal entry 3 lakhs plus in third journal entry 36,000. Next, in 11th journal entry equity share capital is 1,02,000 plus 1,02,000. So here is the value. Consolidation of equity shares. Equity share capital 0.25 account 4,38,000 to equity share capital rupees 1 4,38,000. And narration will be consolidation of equity shares into 4,38,000 equity shares of rupees 1 each. And I think we have only one preference share journal entry or transaction, a journal entry, which is preference share capital 4,80,000. So we have 4,80,000 preference shares. So the entry will be preference share capital account rupees 8 account 4,80,000 to preference share capital account 10. Consolidation of 6,000 preference shares of rupees 8 each into 48,000 preference shares of rupees 10 each. We cover all the adjustment and our journal entry. Now you have to prepare capital reduction account and transfer all the capital reductions effects. Let's see. In first journal entry, we give credit to capital reduction for 9 lakhs. So we will go to credit side of capital reduction, credit side of capital reduction account, and we will write buy equity share capital for rupees 9 lakhs. Buy equity share capital 9 lakhs. Next journal entry, same, we give credit to capital reduction account for rupees 1,20,000. So we will go to credit side of capital reduction account and we will write preference share capital account for rupees 1,20,000. Buy preference share capital rupees 1,20,000 in journal entry second. In third journal entry, capital reduction is debited. So we will go to capital reduction accounts debit side and write to equity share capital account 36,000. In the debit side of capital reduction account, to equity share capital 36,000. Next, in the fourth journal entry, we give capital reductions credit So we will go to credit side of capital reduction account and write buy bank for rupees 1,50,000. Buy bank for rupees 1,50,000. 1 minute. Capital reduction for rupees 1,50,000. Yes, on the credit side of capital reduction account, we will write buy investment by subsidiary 1,50,000. Next, in fifth journal entry, we give credit to capital reduction. So we will go to credit side of capital reduction account and write 6% debenture account. Buy 6% debenture account. 6% debenture account for rupees 12,000. Next, there is no effect for capital reduction. In the 7th journal entry, there is no any information for capital reduction. But in the 8th journal entry, we have debited capital reduction for rupees 60,000. So we will go to debit side of capital reduction account and write to bank for rupees 60,000. To bank rupees 60,000. Next, in the 9th journal entry, we give credit to capital reduction account. So we will go to credit side of capital reduction account and write buy bank rupees 20,000. In the 10th journal entry, we give credit to capital reduction for rupees 30,000. So we will go to credit side of capital reduction account and write buy director loans for rupees 30,000. Buy director loans 30,000. Next, in this journal entry, we give debit to capital reduction. So we'll go to debit side of capital reduction account and write profit and loss account, advertisement, goodwill account, debtors and stock for rupees 9,90,000. To profit and loss account, advertisement, goodwill, debtors and stock. Journal entry number 12. And the last journal entry, the two last journal entries, there is no effect of for capital reduction account. So now we are going to tally our capital reduction account. We have to first add all the credit sides amount. We will get 12,32,000 as a total. Write same amount to debit side and then make total of this amount and subtract this from 12,32,000. So we will get capital reserve which is 1,46,000. So here is our last journal entry. Capital reduction account debit to capital reserve account. Our last journal entry which is capital reduction account debit to capital reserve account for rupees 1,60,000. Sorry, 1,46,000. I hope you understand this problem. Thank you so much. Like and subscribe.